You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, we are back at it again for another week, and it's an interesting week this week. Welcome, Hamish. We've got earnings season starting. How exciting!
Hey everyone, yeah, absolutely. We've certainly got some interesting ones this week, and earnings season, best time of the year. There's always lots.
It's like Christmas, but we get it 4 times a year.
It is true.
It's certainly good for people that make content about the stock market, that's for sure.
Yeah, exactly. There's always those periods in between earnings season where you're running short on ideas of what to talk about or what videos to make, and then earnings season rolls around and you've got too many video ideas.
Yeah, you got way too much to talk about.
Yeah, no, definitely. But
so we got Netflix to talk about today. Delta, Chipotle. Geez, we've got quite a bit to talk about today, and there's some very big news stories that are happening around the world in the world of finance. And some of the big news stories are happening here in Australia as well, which is exciting. Well, in some aspects, but I'm sure we'll get to that. We do have a lot to talk about, so let's crack on. Hamish, who's our sponsor?
Our sponsor for today, for this week, is Sharesight. So Sharesight is an application that I've personally been using over the past few years to keep track of the performance of my stock portfolio. And basically, it'll help you in a number of ways. And the first way is that it'll help you keep track of all of the different types of returns that you would make when you make an investment. So that includes, of course, capital gains, the stock prices of businesses going up, your dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you, which is a huge lifesaver because it's almost impossible to calculate what kind of return you're getting out of the dividends that have been reinvested. It'll calculate your currency gains. So if you're buying shares internationally or if you just hold foreign currencies, it will calculate the return on both of those. And then the main reason why I use it is for when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. And that is sight spelled SIGHT. So sharesight.com/young investors. And if you use that link, you can also get 2 months free when you sign up to a yearly subscription.
Awesome. Thanks, Sharesight, for sponsoring.
Yeah. So, I mean, certainly this week we've had the markets have sort of returned to volatility because obviously over the past few months it's been very volatile compared to last year. But there was a little bit of a break, I feel, at least over the past couple of weeks for some of the businesses I was looking at, where everyone's kind of wondering what's going to happen next with all of this coronavirus stuff. But there was some crazy things going on in the oil markets this week,
which is
it's not one that I follow at all. I can't say that I follow it.
Yeah, let's be honest. You're not going to get the deepest level of insight into the nuance of oil trading from either myself or from Hamish.
Yeah,
it's simply just not something we follow. It's not like it's important for major economies around the world. You know, the US, Russia, Saudi Arabia, but I mean, we only follow it in a broader economic sense. We're not interested. I think I speak for you as well here. We're not interested in buying any oil stocks or anything like that. No. Well, correct me if I'm wrong.
No, you're not wrong. Yeah, I mean, my interest is in assets that produce cash so that I can estimate where they'll be in the future. And oil isn't one of them, but
just before we go, the thing I always say about these commodity stocks is at the end of the day, we try and find businesses with competitive advantages, something that means that they have an intrinsic advantage over their competitors. But the thing about commodity stocks like oil companies is that they're all making the same stuff.
Yeah.
So it's just like I don't know. Imagine if every social media company made an application that worked exactly the same as the other. Imagine if they're like Twitter, Snapchat, they all just had the exact same functionality of Facebook, or something like that. It's like there's no competitive advantage in oil or coal or anything, because at the end of the day, every company's selling the exact same product. Yeah, so that's one of the reasons that I don't particularly look at oil. So
yeah, and when there's a severe drop off in demand, it can cause some sort of waves, I guess, to occur in the oil market. So what happened? What happened this week in terms of oil?
It's basically just the oil. So the oil futures is what everyone was focusing in on, because the other day, the futures market for oil dropped to negative $37 per barrel for WTI crude oil, which is pretty ridiculous. It's now WTI sits at about, I think, at the moment, $13 a barrel. But yeah, having those futures contracts negative 37, so essentially the oil companies will pay you.
Yeah, so head down to your local 7-Eleven and you'll get paid to fill up your tank.
Yeah, exactly right. No, but that's one of the things that we will see as a consequence of what's happening, is that we're already seeing cheaper petrol prices. But yeah, basically drain your swimming pool and fill it with oil.
Yeah, start digging that huge hole for the big oil reserve that you can store.
Exactly right.
50.
Well, that's the thing, is that the whole reason that this is happening is because supply has gone up and demand has dropped off a cliff, obviously. The biggest consumer of oil is transportation, obviously. And with, 90+% of air travel not happening now, just being crushed, and obviously no one's really going anywhere because we're being asked to kind of keep to ourselves and distance ourselves socially. Just no one's going anywhere. So transportation is not really using up much oil at all. And then on the supply side, it was only a month or two ago, I think, there was an OPEC discussion that Russia walked out on. They didn't like the proposed cuts in oil supply. And that triggered a price war between Saudi Arabia and Russia, and they both just started pumping oil as much as they could, because they were just trying to squeeze the other. That now, I believe, has pretty much calmed down. But what it led to just this huge amount of supply. Obviously, demand is just not there, and we're at a situation right now where basically all of the land storage for oil is full.
Wow.
So there's these oil companies keep pumping oil. They got nowhere to put it. There's literally nowhere. That's the whole hoo-ha at the moment, is everyone is trying to figure out temporary oil infrastructure, oil storage infrastructure, so that they can keep getting the oil into storage. At the moment, some of these oil companies, to make sure that they can keep their business running and keep pumping oil, they are hiring oil tankers. They're leasing oil tankers, and these tankers cost $100,000 a day to lease, and they are storing oil on the ocean.
What?
They're just keeping it in. Yeah, I know, it's crazy.
Wow.
So that's just what happens. The supply's gone through the roof, and there's still no demand, and it doesn't look like there's going to be demand for still a while yet. So yeah,
and that's the thing about something like oil, is that there's a term for this in economics, which is called demand elasticity, and it basically means that even if the price of oil goes down substantially, the demand doesn't really react too much to the supply change. So, for example, when petrol prices get really expensive, people like to think that they try to avoid buying petrol, but if their car's empty, they're going to fill it up. And in the same way, if petrol's really cheap and your car's full, most people aren't going out and stocking up on fuel just because it's cheap. People buy
jerry cans.
The demand usually just stays relatively the same to the need at the time. So obviously it's changed because not many people are driving, but when everyone's driving, or when not many people are driving, they're not stocking up on fuel because the price has become cheaper. And that's a big problem for these oil prices.
Yeah, and even countries are trying to stock up on oil, but countries are full. Like, I'm pretty sure that Australia doesn't have. I don't believe we have very good oil storage infrastructure anyway. But it's basically everywhere, every country around the world. It's like the pipes are full. There's nowhere left to put it, which is just ridiculous.
No more.
But yeah, exactly right. It's interesting because oil is one of those things that is just in constant demand. Like, you're right. Even most economic situations don't really make oil, oil demand go down as much as what it has at the moment. I mean, this is just a freak situation, like a pandemic that's really halting all transportation. It's halting manufacturing. Of course, oil's used in plastics. So all this manufacturing stops. So oil isn't needed there. It's really the air travel being halted that, kills the demand there. It's just this odd, very rare circumstance of demand going down and supply going up that has just led to this absolute collapse of the oil price. But very interesting.
Yeah, I mean, and it also just shows how connected everything really is economically, in that we start with a pandemic, then borders are closed down, so flights stop, and that impacts the demand for oil. And so what starts as one sort of health crisis flows into this industry and then that industry, and it kind of spreads. It spreads like a virus.
Yeah, exactly. It's interesting. Yeah. Terrible joke.
Okay, I'm going to pretend I didn't say that.
No, I agree. I agree. It's interesting to see how an issue like this can have such broad economic impacts. Yeah.
Yeah. All right. Should we talk about some of the impacts in companies specifically?
Yes.
Because we have some, of course, it's earnings season. If you didn't know, we haven't really, I don't know if we've mentioned that it's earnings season. Have we mentioned that it's earnings season? It's earnings season.
Yeah. To be honest, we should stop being so sarcastic in our podcast. I don't understand why. Like, is this maybe an Australian thing? Are Australians particularly sarcastic? But I've read a fair few comments now on our videos, which is just like people taking what we say literally, when to me, I feel like we're quite obviously being sarcastic. I don't know. Anyway.
Yeah, I think 50% of what I say is sarcastic. So just
take it. If we say something that seems a little bit out of place, just assume that we're being sarcastic.
Yeah, please. I'm not a bad person.
Yeah, we promise we're not bad people. All right, Netflix. Let's talk about Netflix first. I really want to talk about Netflix. Such an interesting example, because there's so many question marks leading in to this quarter. People staying home. Does that lead to more money for Netflix, more subscriptions? Do they lose money because Disney Plus is ramping up as well? There's a lot of questions that need answering. So I want to start with the numbers. So this is for, obviously, Netflix Q1 2020 earnings. They had quarterly revenue of $5.77 billion, which is up 5% or $300 million from the last quarter of last year. So that's pretty decent growth, and it's up 28% versus the first quarter of 2019, so year over year. Then if you drop down to their operating income, their operating income's now up to $958 million in the quarter, which is an increase of 109%. It's an increase of $500 million from Q4 2019, which is pretty crazy. And it's mainly due, I broke it down and looked at the numbers a little bit further. That's mainly due to, yes, the increased revenue, but they also spent $375 million less on marketing in this quarter.
Right.
I had to flick over to their balance sheet, and they've been steadily increasing their long-term debt. They're now up to $14 billion of long-term debt. And then flicking over to their cash flow statement, they actually did post positive operating cash flow, which pretty much that doesn't happen for Netflix. Very rarely happens for Netflix. In fact, it hasn't happened in the last few years. I can tell you that with 100% certainty. So positive operating cash flow of $260 million. Plus they spent $100 million on capital expenditures, which is in line with what they spent last quarter. So can you believe it? Netflix, I can't believe I'm saying this, achieved a positive free cash flow for the quarter.
Yeah. they accidentally made money for shareholders.
They accidentally made, yeah. That's what I was thinking. I've written down here. So basically, for Netflix to be a profitable company, the whole world, there just needs to be a global pandemic occurring 24/7, 365, just to make sure that everyone's stuck at home all the time with nothing to do. And if that happens, then they'll make money.
Yeah, that's basically it. Stop spending money. Force them to stop spending money on shows. Stop spending billions of dollars every year and taking on more debt.
Yeah.
Just for a quarter, they can make a little bit of money.
It's pretty. Yeah, it is pretty funny actually. But I mean, it's not unexpected in a way because like we knew that this was probably going to happen because everyone is staying home. You know, a lot of people have been, stood down from jobs. They don't have much to do. People working from home and not having to travel to or from. They got more time on their hands and that sort of stuff. We can't go out and see our friends. We can't kind of go out to the movies, see a movie. So that naturally, that entertainment, spend, both financially and time-based spend, is going to trend more towards the television, and Netflix has benefited. But Netflix isn't the only one. We've got Disney Plus, which has heavily benefited from it as well, and I'm sure we'll see that reflected when Disney release their earnings. I think probably next week, is it, or maybe the week after?
May 5th. So
okay, so we've still got a little while to wait.
Yeah.
Okay. Right.
Yeah, I really wish that companies that had similar industries would report all together so that you could compare them all.
I guess we just have to compare them in a couple of, at least for most companies, they don't mess around with the quarters. So at least we're comparing the same, True. January, February, March, unless you're like, what is it? Carnival, I think their Q1 was like, what was
November or something.
It's like. Or their Q2, it was like December, January, February. Yes, why would you do that to us?
Something stupid.
It's so stupid. But I actually like credit to Netflix. I mean, yes, the global situation has helped them a lot in making money, but I mean, their results are actually, they could have been better. They could have been better because they actually lost out on $115 million through FX. So essentially what this means is that the US dollar has risen recently, and they report they're an American company. They report their earnings in US dollars. So when they bring their international revenue back to the US, they get less US dollars from that same revenue because the US dollar is stronger. So they've lost out on $115 million this quarter through foreign exchange. So taking that into account and the numbers they posted, it's pretty impressive. But having said that, I mean, the only reason they posted this is because there's a business shutdown and everyone is watching Netflix right now because they're all at home.
Yeah, there was a line in the press release from management that was explaining why they were free cash flow positive. And then after that, they said, but of course, that spending that was supposed to happen in this quarter will be happening in a future quarter. It's kind of like the management saying, don't worry, we're going to spend the money. We're going to
spend the money.
Don't worry about being cash flow positive this quarter. I know we didn't mean to. We'll get back to heavy negative cash flows and taking on more debt in the future. Don't worry. We got you.
Yeah, they also said that they expect a weaker second half of the year if the quarantine orders are lifted, because what they said here is that many people who would have joined then are likely to have already signed up.
Right.
They're kind of saying, we look great now, but probably not going to look that good. But in terms of, so one thing that I haven't said yet is their subscription data, because they report that as well. So it says here that Netflix added more than double its target for subscriber growth during its first quarter, adding 15.77 million paid subscribers globally, the highest it has ever gained in a single quarter.
Wow. That's
year-over-year growth of 22%, which is pretty impressive. And that brings them to a total subscription number, paid subscriptions, of 182.9 million.
Wow.
That's quite a lot.
Yeah.
That's quite a lot. They're by far the number one in terms of streaming service subscribers.
Yeah, definitely. And the thing about what is happening at the moment is that there would be a lot of people who never had a Netflix subscription or maybe even never had a streaming service subscription, but got one because, they're locked in the house and maybe they have kids and they need to entertain them or whatever. But after all the lockdown goes away, I'm sure that a substantial amount of those people will have gotten used to having a Netflix account and will leave it on. So in a way, there could be many people who would have never had a Netflix subscription be attracted to getting one and then keeping it over many years as a result. So that'll be a huge benefit to these kinds of these companies going forward. A lot of people will cancel and go back to their normal life without Netflix, but a substantial amount will stay on. I would assume the same would be true for the others, such as Disney Plus.
Generally speaking, streaming services typically offer good experiences, right? So I think it's more likely that someone will get Netflix and will be impressed by it in the same way that I think someone might get Amazon and would be impressed by it, or Disney Plus and would be impressed by it, than those that would get these subscription services and go, oh, this sucks.
That's a good point.
So yeah, I feel like more people that get it, they've jumped the hurdle to actually go and plug their numbers in and accept the cost and get it. I think more people would stay than what would leave. But
I'd agree with that.
Yeah, no, pretty cool. And I'm interested to hear about Disney, and I'm not sure if Amazon when they report, but I don't know if they give data about Prime subscriptions. But
they do, but Amazon Prime includes the free shipping service, which is really the main thing that drives their Prime subscription. So you can't really use it as an indication of whether people want the video subscription service. So there's that.
Yeah.
And we'll also hear from Apple and their service, but at the moment they're giving out free subscriptions to anyone who buys an Apple product. So that number's just completely propped up. I think that's pretty cool. I think they had about 25 or 30 million subscribers at their last report.
And Disney Plus has just gone past 50 million. I think you said that last week as well.
Yes, yeah.
So, I mean, I think Amazon Prime has over 100 million.
Yep.
So I don't know. But, interesting. Anyway, should we leave Netflix there and move on to a different company?
Yeah, for sure. I can take us through Chipotle.
Chipotle.
So
I'm estimating 50% growth in Chipotle lanes.
Yep.
That's what I'm estimating.
Get your guesses in, everyone. How many new Chipotle lanes will there be?
I'm guessing that the Chipotle lane is such a revolutionary concept that they are now licensing the idea to other companies. I reckon they might even license this idea of a Chipotle lane to McDonald's. Yeah. I think McDonald's will probably scrap the drive-through, and I think that they will put the Chipotle lane, the McLane in,
or they just put in a Chipotle lane, and every time someone comes through, they have to pay a licensing fee a royalty.
I think that's the way it's going to work. I think so.
Yeah,
I think that's the way because it's just so revolutionary, this idea of a Chipotle lane.
I'm pretty sure on this show.
No, don't. Someone's just invested in Chipotle because of what we just said.
Yeah. Wow, really? Really? Partnership with McDonald's? I'm in.
Gosh. Yeah. Next, imagine if you just looked up Business Insider. It's just reports coming in that Chipotle has a deal with McDonald's.
Anonymous source.
Anonymous source, allegedly.
Yeah, allegedly. That's the word.
Yeah. Allegedly. Yeah. Anyway.
In terms of, so they reported first quarter earnings. So there's some interesting stuff to talk about here. So the revenue was up 7.8%. So they still grew revenue.
Really? Wow.
And
okay.
So we can sort of talk about where that came from. So we had comparable sales, which was up 3.3%. So that's the number of that's basically the sales or revenues generated by stores that had existed for at least a year. So a portion
so it's whether
came
the stores themselves are getting better.
It pretty much exactly.
Okay.
So a little bit of growth came from there, about half. They opened 19 new stores. So they continue to open stores through all of this, which is pretty impressive.
Wow, good on them.
But in terms of transactions were down 1.4%. So comparable sales.
1.4%?
1.4%.
Yeah, doesn't seem like much though.
No, it's not really that much. So I mean, comparable sales, the sales in restaurants can grow either by the number of transactions or the value of those transactions, of course. So clearly this was less transactions, but people were buying in higher quantity. But interestingly enough, this is the bit where it gets real interesting. So in January and February, before all of this stuff had happened, comparable sales were 14.4%.
Wow.
Which is insanely high. If those who don't know, I think the industry average is like 2 to 3%. So
they gave January and February and March details in their earnings, did they?
Yeah, that's the other thing as well. Is this is the kind of management team that knows that investors want to know these things specifically. That the overall quarter doesn't really paint much of a picture, because if you look at overall comparable sales, it's 3.3%. But if you break it down, it's more accurate to look at it as 14.4% before the crisis. And then in March, what it was negative 16%. So
wow.
If you look at those two, 3.3 doesn't really tell you anything, because it's just an average of two completely different situations, one where they're operating normally and one where they're clearly not. So it's fantastic that they broke it out like that. But to have 14.4% comparable sales growth is just insane. That's insane.
So what that's saying is essentially, in a normal market environment where there isn't a global pandemic, Chipotle is actually growing really quite a lot, and it's quite impressive. And the only reason that their numbers don't look amazing is just because of what's going on what happened in March.
Yeah, exactly right. And they had an 80% increase in digital sales, an 80% that is, and that brought their digital sales up to about 25%, I believe it was, of their overall sales. So that's helping them not lose too much revenue throughout all of this, because a substantial amount of people use delivery services, or they're using the classic Chipotle in order to order their food. We're getting to the Chipotle update, okay? We're getting there. All right, we're building up to it. In terms of their financial position, so they have $900 million in cash, and they have no debt. So
that's good.
Their financial position is pretty good. The only substantial liability that they have is their operating leases. So for, I think, most of their restaurants, they lease the property, the land. So they're obligated, of course, to pay those ongoing leases. So that's their big obligation, but they have no long-term debt or short-term debt or anything like that.
Do they lease their? I wonder if they buy or whether they lease their equipment.
Yeah, I'm not sure.
Don't know,
actually.
Yeah, it's just something that popped in my head. We'll have to check that.
Possibly.
But yeah, you're right. They definitely lease the land that they put the Chipotle stores on.
Yeah, absolutely. Yeah, and then in terms of earnings per share was down 14%. So even though revenue was up, their profitability was severely hurt because of an increase in expenses, and cash flow was about flat. It was about zero. It was negative 1% or something like that. Okay. So that leads us to this is the saddest part.
Here we go. Saddest.
This is the saddest. I've got sad news, guys. I'm sorry. I've lied to you.
All right. Thanks for listening today, guys. We really appreciate. Just before we get to that, that's all we've got time for. And thanks,
Brandon. We have to face up to this. Last week we promised an update on Chipotlanes. And unfortunately, there was no mention of Chipotlanes in this press release.
Not even a mention.
Not even a mention. I did the classic search document. No mention of any Chipotlanes. No. So we've got no update.
My whole investing thesis was around these Chipotlanes. God damn it.
Yeah. I don't know what I'm going to do now. I'm just going to...
Well, I just don't know how are we going to come back from that. Jeez. I just don't even know what we're going to talk about next.
Yeah.
All right. How about we leave that there and we talk about something that could be potentially a more happy thing to talk about. Yeah. You could get $1,500.
Whoa.
A fortnight.
Tell me more.
You could. We did talk about this last week. This is the JobKeeper plan. I just thought I'd follow up because we did a bit of a PSA last week before the official document had been released. If you wanted to nominate yourself as being eligible for this JobKeeper plan, where it's essentially like if you've been stood down from your job then and you're not earning any money, you basically get $1,500 a fortnight for just to help you get through this current time. So the ATO has now released the official eligibility criteria, and there is if you are eligible, you have to fill out one of these forms, these ATO forms, and send it to your employer. So the eligibility criteria is as follows. So first point, you are currently employed by the employer that has stood you down, so that should be obvious. You were employed by the employer as of the 1st of March 2020. And then as at 1st of March 2020, you were a permanent employee or a casual employee employed on a regular or systematic basis during the period of 12 months ending 1st of March 2020. If you are a casual employee, as mentioned above, you are not permanently employed by any other employer, or you are only employed by any other employer on a casual basis. Then the next point, you have to be at least 16 years of age as of the 1st of March 2020. As of the 1st of March 2020, you were residing in Australia and you're an Australian citizen or a permanent resident, all those classic ones. You are not in receipt of a JobKeeper payment as a sole trader, nor is another employer or eligible business in receipt of a JobKeeper payment for you. So you can only go with the one, obviously. You are currently not receiving parental leave pay or dad and partner pay, and you are not currently totally incapacitated for work and receiving payments under an Australian workers' compensation claim or anything like that. So it's actually although I did just say a lot there's actually not too many. I mean, most Australians would definitely hit the criteria. So it's worth having a look at whether you're eligible, and if you are, then make sure you act now. Okay, act. If you're eligible, then get your shit together and fill out this form and get it to your employer.
Definitely, absolutely.
Yeah.
Thanks for that PSA.
That's all good. Moving on.
What should we talk about?
Here's another sad story. Virgin Australia goes into voluntary administration.
Wow, lots of sad news recently.
Yeah, well, I mean, it's a pretty sad time, not going to lie. Were you expecting the news to be happy, Hamish?
No, not particularly. Well, I mean, I thought the Chipotle thing would give me something to look forward to.
Yeah, well, we can't always,
you can't
always have what we want. Anyway, very sad news. Virgin Australia goes into voluntary administration now. This doesn't mean they're going bankrupt, which we'll talk about in a little bit. So essentially, we were discussing whether they'd get that $1.4 billion from the government as a bailout. They did not get that. And the reason for that, Frydenberg basically said he didn't want to bail out Virgin Australia because it's basically owned by 5 foreign shareholders. And those 5 foreign shareholders together own more than 90% of the business. So if you break down Virgin Australia, even though it's Australian business, apparently, it's actually owned 20% by Etihad, 20% by Singapore Airlines, 20% by the Nanshan Group, 20% by the H&A Group, and then 10% by the Virgin Group. And then everyone else is about 10%.
Wow.
So I think it's kind of fair enough. You don't want to use Australian taxpayers' money to bail out foreign, an Australian company that's basically entirely owned outside of Australia. But yeah, anyway, so the situation was not looking great for Virgin Australia. So they called in the voluntary administrators from Deloitte. And the administrators are coming in, they're going to have a look at the business, but basically the administrators get called in, they're independent people, they come in and they have a look at how the business can get through a near-death experience, essentially.
Yeah.
So the voluntary administrators are currently saying that they are hoping not to cut any jobs. Their job, they see, is to keep the workforce and get Virgin Australia flying again as much as they possibly can. So their job is to try and recapitalize the business so that they have the money to get them through. And apparently so far they've got interest from about 10 parties. But in all honesty, I'm not exactly sure how all of this works with the whole voluntary administration versus bankruptcy thing. It's not something that I've studied in depth. So maybe if you are someone that understands this in much more detail than what we do, please leave us a comment. But it sounds as though they're basically just looking for more investment money to try and get it through, get the current business of Virgin Australia through this difficult time and get them back flying with the same workforce, with the same planes, with the same schedule and that sort of thing.
Yeah. My very basic understanding is that there's obviously people that Virgin owes money to, and there needs to be some kind of deal between some new investors, some new parties who are interested in getting ownership in Virgin, making a deal with the people who Virgin owes. And if that deal can be made, then the company will continue to operate. And if it can't, the creditors, the people who Virgin owes, will liquidate the company, basically just try and get as much out of its assets as possible and collect back as much of their money as possible. But even if they do survive, it's not, neither of those are good outcomes really. One's obviously better than the other. One is, a lot of people get to keep their jobs, but the airline is still going to be severely hurt. And it's
definitely
the previous shareholders have still been hurt substantially by that as well.
It's not a great situation for Virgin Australia. However, I mean, it might be, they might find a solution that's better than bankruptcy, which is, I guess, what you just got to hope for. But I don't know. What do you think about, do you think it's a fair decision by the government not to come to the rescue here? Considering that it's basically owned by foreign companies?
Yeah. I mean, there's a good argument on both sides. So I really don't know. I mean, you can definitely say, are you going to bail out a company that, its sole purpose is to maximize profit for foreign investors? But then on the other side, you have a company that is based in Australia. They're all Australian employees, or at least for the most part. So are you bailing out them, or do you do what Frydenberg did and decide not, or what the government did and decide not to bail them out? I actually don't know. I honestly, I've thought about it a lot, and I think you have to just take it on a case by case basis with these bailouts, because there's always externalities. There's always other parties that are going to be impacted by these, whether they're bailed out or not. And you can't just say, no bailouts ever. That's not fair. And you also can't say you should always bail out these businesses. It's got to be case by case, I think. That's my view, at least.
The way I think about Virgin Australia is that it's essentially like having a foreign company open up stores in Australia. That's how I think about it, because it's kind of like
True.
Yes, though that business is employing Australians because they're operating stores in Australia, but at the same time, the profits that they make just get shipped off to foreign owners. So I probably err on the side of don't bail them out, as long as it's not catastrophic for the airline industry or for the people that are employed by Virgin Australia. But exactly right. It's like, how do you make that call? Because you could say there's another argument for it, that Virgin Australia needs to be bailed out so that they don't go bankrupt, because if they do go bankrupt, then we are flying Qantas. In which situation, unless the government makes some sort of laws around restriction on air ticket travels, then if we wanted to go to, Sydney or fly to Perth or something, then it could cost us a hell of a lot more. If Qantas are the only player and they go, oh, okay, you want to get to Perth, you can either pay $1,000 for one way, or you can spend a couple of weeks driving over there.
There's just so many. There's so many stakeholders that get impacted whether they get a bailout or not. It's not just the shareholders that are getting impacted. If they bail out the shareholders, yes, you're bailing out a foreign company, but you might be saving a lot of customers a lot of money by keeping it competitive, keeping a lot of people to have their jobs. I mean, there's just a lot of people. A lot
of factors.
Yeah, I don't think there's any. I mean, at least personally, I don't know if there's a right answer.
I mean, let us know your opinion too. Go over to the YouTube version and let us know what your opinion is, because I made a video on this, and I think that the majority, I mean, it was pretty split, but the majority of people would probably say that they don't deserve a bailout just because of the foreign ownership thing. But yeah, we'd be interested to hear what you think about the situation. So let us know over on YouTube. And I think with that said, keep rolling with these airlines and talk about Delta as well.
Definitely.
So I'll just get this up. So here we go. So Delta Airlines is a big US airliner. They report their first quarterly loss in 5 years, which is pretty crazy.
Wow.
I thought that it would be better. I thought that it would be worse than what it was, though. So their revenues for the quarter dropped 18% year over year to $8.6 billion. That led to negative $410 million of operating income. However, they maintained positive operating cash flow of $358 million, although that number was down 82% year over year.
Right, okay.
So, yeah, not particularly good news, but again, as what we were saying before, the restrictions only came in maybe March where they got really strict. So probably going to be hit harder in Q2 than Q1.
Yeah, you would imagine that. I mean, if Q2 is April, May, June, we're in April at the moment and we're right at the end and everything's still pretty locked down. So it'll depend on whether March and June, I guess, are both still in complete lockdown or whether maybe... May and June, not March and June.
Yeah,
May and June, or whether it's just May that's in complete lockdown and June some restrictions have been lifted, or maybe May some restrictions have been lifted. I don't really know what's going to happen there, but that'll be what sort of drives second quarter results. And I believe that the market doesn't know. I mean, the market doesn't know what's going to happen either. So that'll be another big mover, I think, for companies like Delta, but other companies as well.
No one knows what's happening. We got over in the States, you got the government saying, we want to open everything up, Donald Trump is like tweeting, liberate this, like open it up. And then all of the like infectious disease scientists are like, don't open it up, for crying out loud. Do not do it. Yeah. Anyway, so it's a bit of a battle. But to be honest, I think what will happen is that because Trump's in control of this government, they'll start to open everything back up and then the disease numbers will just spike again and then they'll just have to close everything back down again.
Yeah, that's a very real possibility. Yeah.
I mean, basically all of the infectious disease scientists that I've been hearing online are just saying, please do not open back up. I mean, that is stupid.
Yeah.
But yeah, anyway, it's an unknown. We'll have to wait and see. But anyway, going back to Delta specifically, I've got a couple of points here. This article reads, CEO Ed Bastian said second quarter revenue will likely fall 90% from the same period of 2019.
Wow.
And forecasts a long recovery, telling employees that the airline will be smaller in the future. He says, we don't know when it will happen, but we do know that Delta will be a smaller airline for some time, and we should be prepared for a choppy, sluggish recovery even after the virus is contained, he wrote in a staff note. I also estimate the recovery period could take 2 to 3 years. I hope it's sooner, but we need to be realistic in our planning. At least he didn't sugarcoat it.
Yeah.
At least that's, to be honest, that's probably a sign of a good CEO. He didn't try and sugarcoat it. I mean, he just told employees and he's telling shareholders exactly his line of thinking and the company's line of thinking and the way it's going to be. It's better that I guess he tells everyone up front as opposed to getting to that time and saying, oh, look, oopsie.
Yeah, no, exactly right. Yeah. It's good that he's being honest now.
Yeah.
Probably should have been keeping his eye on the ball when they were doing all those sherry purchases.
Yeah. God, those sherry purchases are just crazy. Anyway, they're certainly paying the price now. In fact, Delta raised, this is since the end of March, Delta's raised $5.4 billion, including $3 billion term loan, $1.2 billion from aircraft sale leasebacks, and it also drew down $3 billion of an existing credit facility and cut planned capital expenditures by the same amount as well. So
right, okay, yeah.
It's pretty crazy. It's to be expected. You look at a company that puts themselves in that kind of financial position, look at their balance sheet, and all of a sudden a pandemic like this happens. I mean, it's to be expected that they'll have to raise more money to get them through. I mean, I've got a note here that it says that the carrier burned through $100 million a day at the end of March, which is pretty crazy. Yeah. So, I mean, it's just to be expected. They're going to run out of money if they don't do anything.
Yeah. I mean, even that $5.4 billion they just raised, how long does that last at $100 million a day?
Yeah.
How many days is that?
54 days?
That's not many days. I mean, maybe how long was that 100 million a day for? Was it the whole of March?
I'm not sure, because I've also read reports that they're burning, like Ed Bastian himself, the CEO of Delta, has said that they're actually burning $60 million a day. So I don't know.
Oh, okay. So yeah. But either way,
it might be in the region. Yeah. It's still a big burn rate.
Yeah. I think, I mean, I could imagine that international flights will be off the table for a very, very long time for a lot of countries. But I could imagine that domestic flights come back in the next 6 months. So it's just a matter of, I think, that whether how exposed some of these airlines are to international flights that I'm guessing would be closed for a very long time. I don't know, but that would be, I think international flights will be the last thing that that a country sort of opens up.
Yeah, probably.
We'll what's our saying? We'll have to wait and see.
Have to wait and see. All right. I think that's the end of our last news story too.
Yeah, it is.
Have we talked about everything? Yeah, we've talked about Netflix. We've talked about Delta, Virgin, oil. Yep. So let's then move into some Q&A questions.
Q&A.
So as always, just a reminder, if you wanted to ask a question for the Q&A section, head over to the YouTube version of the podcast and ask us a question in the comments section. And we have a look at the comments section and just tally up any questions we get and talk about them here on the podcast. So here we go. First question for today. What websites are good to see a calendar of upcoming reports from companies? Oh. Hamish, if you want to know what's coming up, where do you go and look?
Yeah, that's a good question. Yeah, so I just go to Yahoo Finance. So if you just do a Google search for Yahoo Finance earnings season calendar, they have a pretty good calendar where they go day by day. And there are a lot of companies in there, so it can be a bit tedious if you're just looking through all of them. But that's one way that I go about it. And then, of course, for the companies that are on my watch list or in my portfolio, I just go directly to their investor relations page and I make sure that I'm subscribed to the email list that lets you know when earnings are coming out in the future. And that's kind of how I keep track of it all.
Yeah. To be honest, I'm not as organized as you. I just Google it. Yeah. But yeah, you can basically just Google earnings season Q1 or something like that, and there'll be a whole host of different websites that will give you a calendar or some variation of a calendar that will tell you when different companies are going to report their earnings.
Yeah. All right. Should I pose this question, next one, to you?
Yeah, sure.
So this one from Henry. Hi, Hamish and Brandon. What is the most important metric that you look for when analyzing a group of stocks? Is it earnings per share growth, low debt levels, equity growth, or return on invested capital?
Well, we're definitely going to say the same thing on this one. It's really hard to hone in on one particular metric just because they all tell you something different. For example, I love to look at revenue growth, but revenue growth is just one factor. I like to see that, operating income is going up over time. I like to see the operating cash flow is going up over time. But at the same, this is one of the points that I can see you've made here. At the same time, if they're making much more money, but in order to do that, they are taking on just unbelievable amounts of debt, then obviously that investment no longer looks so good. It's very complicated, and I wish there was an easy way to hone in on, just look at this number and this number and this number, and then you're all good. But at the end of the day, I mean, companies are quite complex how they make money and where they get their money from and all that sort of stuff. These are all these different factors. So, you have to pay attention to things like how are they growing with their revenues and their free cash flows. You have to look at, well, what investments are they making? How are they funding that? Are they taking on debt? Are they selling new stock? How much cash have they got in the bank? Have they got a cushion there? There's just all these different things that don't really get summed up in one number. I don't know. Are there metrics that you like to look at more than others?
Yeah, well, I mean, there's certainly key metrics, some of which you just, Henry listed there, earnings per share growth, low debt levels. There's some key ones that I focus on, and there's ones that I don't look at all. But of the ones that I'm looking at, they're all super important because, as you said, they tell us information about a different aspect of the business. And the way I like to think about it is, for each of these elements that a business does not satisfy, the uncertainty goes up, and the confidence that I have in that investment goes down. So it might be
it's a good way to look at it.
Might have high growth, as you said, but if it also has high levels of debt, then its short term is pretty uncertain. If there's something like what's happening right now happens, that growth might get slashed, where the cash flows they're expecting throughout the rest of the year might not come in, and now they have all this debt due. And on the same flip of the coin, they might have really low debt so that they have no risk of suffering through a period like this. But if they're consistently slowing down in terms of the number of sales, so less customers are coming back, then that's not going to be a viable long-term company. So they all kind of play their own role. And when all of these elements line up together, it indicates to us that this is a company that has a high certainty of being a great company in the future. I guess that's kind of how I would answer that.
Yeah, and I think that what you touched on a little bit there, they tell you different things about different aspects of the business. If you're looking at revenues and cash flow numbers, then that might show you, just how well the business is growing. And then you can flip over to looking at something like the debt levels and the return on invested capital, and that's telling you more about what the management team is being able to do with the business. So yeah, it's just like these. I guess that's why we boil it down to like understanding the business, checking for a competitive advantage, checking that the management team operates with skill and integrity, and then checking for a margin of safety. Because if you go through those 4 steps that systematically, then eventually, if you're looking at earnings per share growth or low debt levels or equity growth or return on invested capital, like what you've listed, Henry. If you go through those 4 steps and all the subsections of those steps, then you will eventually cover all of those bases. So,
investing in companies and trying to outperform individual companies and trying to outperform the market, it's kind of like building a house of cards. Like if one element isn't right, it really doesn't matter in some circumstances if all the other elements are on point. If you have a fraudulent manager in place, it doesn't matter how compelling the competitive advantage is or how low their debt levels are. The companies.
Yeah, exactly.
So, yeah.
Yeah, no, that's a good point, actually. Okay. Should we do one more?
Yeah.
And then finish up?
Let's do one more.
What one do you want to do?
Let's do this one.
All right, sure. So this question comes in from Timothy and asks, how important is looking at book value at times like this when growth prospects are coming into question for a lot of businesses when trying to find value? I understand debt levels are super important. Thanks.
Yeah. I mean, book value is important in that I like to see it consistently growing over time, because an increase in book value over time indicates to us that the company is taking profits, taking cash flows, and reinvesting it back into the business, either by reducing the debt and the other obligations they have, or by increasing their assets, increasing their investments.
So are you saying for your definition of book value, you're talking like just kind of assets minus liabilities and looking at the equity?
Yeah, so book value as a definition equaling to equity, even though I know there's a couple of different definitions of book value.
Yeah, it gets a bit murky. I just hear some people, but I always assume like book value is the value of the business on their balance sheet, which is their equity. It's their assets minus their liabilities. But anyway, sorry, I interrupted.
No, that's fine. Yeah, so it was important to clarify that. Yeah, so it is important that I want to see that consistently growing over time. But for me, what I care mostly about is future cash flows, because ultimately, it will be those future cash flows that can then grow the book value and hopefully grow the value of the business with that,
Right.
or be distributed to shareholders. So it's kind of like book value growth is one side of it. Book value growth might represent the increase in the value of the business, whereas it doesn't show us anything about the cash that's being distributed. So I like to look at future cash flows. And in terms of growth coming into question at the moment, growth coming into question for a substantial amount of companies at the moment is only in the short term. So for really great companies that have low levels of debt, they have competitive advantages, they've been prepared for these kind of events, the slow growth in the short term really won't impact their business 5 years out, 10 years out. So that's not something that I consider too much. I guess what I'm getting at here is a question that I've seen quite a lot is, how does what is happening at the moment change the intrinsic value that you calculate for businesses that you're looking to invest in? And for the most part, if they're great businesses, it really doesn't change that too much. It might slightly reduce the amount of cash I think I can get out of a business when I'm adding up the next 10 years. But for the most part, what is happening now will not impact great businesses. I hope that kind of gives an answer to that question.
I go back to what you're just saying about looking at the cash flow. And you're right. I tend to say that cash flow is what fuels the growth in the equity.
Yeah, exactly.
It's kind of like if you have strong cash flow and that's the fuel, and then you have a good management team that makes the right, can generally make the right decisions, then that combination is what will grow the value of the business over time. I agree. I agree to look at cash flow first.
Yeah, actually, I have an example that I can talk about because I just recently was looking into Visa. And the reason why cash flow for me is still more important than book value is, as I said before, cash flow represents in many ways the total amount of return to shareholders. Either it goes back into the company, reinvested, grows the value of the company, or it gets distributed to shareholders. And
it'll get to us one way or another.
Yeah, and Visa is a good example of this because as they've grown, their book value really hasn't gone up that much. It's gone up by a couple of percentage points over time, but their cash flow growth has been huge. And the reason why is because they don't really need to reinvest a lot to grow. They just have been growing. So
their business model just grows itself.
Their business model is just really good. It's just a great business model that has a networking effect whereby more people are using their payments network.
Yep.
And as a result, they're distributing most of their cash flows every year, either through buybacks or through dividends. So in that way, book value isn't really increasing, but I would say that the value of Visa is increasing.
Yeah, for sure.
So I guess that's kind of an example for that.
And there's an example of how important an economic moat is for your business.
Yeah.
I mean, look at that. Visa's moat is literally just driving the growth of their business, even though their book value isn't really going anywhere.
Yeah,
that's amazing.
It's one of those fascinating companies that has huge margins, very, very profitable, and they don't need to reinvest much to grow. They reinvest a very small amount. Not many companies can do that.
That's amazing.
Think of a restaurant company. If they want to grow, they have to reinvest a lot back into new restaurants. A lot of money. So, yeah.
No, it's super interesting. All right. Well, I think we might finish up there.
Yeah.
Sound good?
Yeah, let's round it out. Thanks.
Rounding out to about an hour.
Yeah, it's pretty good. And thanks everyone for tuning in once again. Really appreciate it. And if you haven't already, head over to the YouTube version of the podcast. You can support us over there. And you can also set up notifications so that you get notified when the podcasts are released. So you can head over to the Young Investors Podcast YouTube channel and subscribe. You can also check out our channels if you're interested. Aussie Wealth Creation and Hamish Hodder. We should say a special thanks to our sponsor for this week, Sharesight. And just a reminder, you can try Sharesight for free by heading over to sharesight.com/young investors. And you can also use that link to get 2 months free if you then decide to sign up to a paid subscription.
It's a good service. It's actually helpful. So definitely at least check it out. I mean, it's free.
Yeah, it's free. Why not?
All right, cool. Hey, that'll do us for today. Thanks very much for listening, guys. We'll see you guys next week.
See you later.